Okay, if you have kids, then likely you're going to be up against some pretty big purchases down the line. Probably the first one might be a new car for them. After that, you have college tuition, college expenses. If you have a daughter, it might be a wedding. Whatever it is, might be helping them start a new business. So, why are we giving our money away to these banks, taking out loans, taking out student loans? Putting our money into specific accounts that we can only use it for education, nothing else, taking out small business loans when you can create your own bank for your kids. How do we do that? Well, my name is Greg Crawford. I'm the founder of the Crawford Health Group and also of Vintage Dad Life. So, in this video, I'm going to talk about something that I help my clients with. It's a great financial tool. I'm actually using it. I'm starting one with my kids. And what it is, it's a juvenile whole life policy. So I know it sounds a little weird to take out a life insurance policy on your kids, but it's not really meant for the actual life insurance itself. It's meant for the financial vehicle that it's used for. Um, and there's a lot of benefits to it. I'm going to go through some quick benefits in this video. And what it is with the whole life, you have the life insurance part of it, but then you have a cash accumulation part of the policy. The cash accumulation part of the policy with a whole life is not tied to the stock market. It actually is held with a mutual company, which is a life insurance company that's not a publicly traded company. So they don't have to answer to the stockholders. They actually answer to the policy holders. So we use a mutual company, whether it's Mass Mutual, Penn Mutual, a couple other companies we work with too. And the mutual company pays dividends every year. Okay. So the companies we use have been in business for over 100 years, and they've been paying pretty historic good dividends over those 100 years. Sometimes they go up, sometimes they go down a little bit, but they hover in the 5 to 7% dividend range, which is really good. The other benefit too is that it grows tax free, and you could take the money out with no limitations. So I'm going to show you how that works in this video and give you an actual example of a couple of the policies that I worked on for some clients. Okay, so we're going to be talking about how to create your child's own interest-bearing banking system where they're gaining 5 to 7% interest tax-free through dividends. And you can actually use this policy and take out loans on the policy to pay for those purchases that we talked about. And with those loans, the cash value continues to grow. And I'm going to show you how that works, because you're not actually pulling the money out. You're taking a loan off the value of that money. But it's a loan that you control. So you can decide to pay that loan back. You can delay paying that loan back, or you can decide not to pay the loan back, actually. Now, I'll show you how it affects the policy, but it is possible. Well, so let me go to the next slide. So let's just talk about some of the benefits of taking out a juvenile whole life policy with your kids. Number one, it grows in a tax-free environment inside the policy. As long as the policy is active, there's no taxes applied. And then when you take money out of the policy, it's also non-taxable because you're taking it out as a loan. That money is growing through dividends that the mutual company pays every year. Average is about 6%. The second benefit is you're securing the insurability of your child early on. So let's say maybe they have some type of health issue later in life, maybe in their 20s, 30s, and then they get married, and then they're not insurable to protect their own family. Well, they're going to have this set up at such an early age that they could carry it through the rest of their life. Number three is you could take tax-free loans off the policy like we talked about. So this is actually how we create our own banking system. And then number four, there's no limitations. So you can take the money out whenever you want. There's no limitations as far as, age-wise and so forth. And then number five, no market fluctuation because the cash value growth is not tied to the stock market. It's strictly through dividends. And then number six, it also comes with a guaranteed death benefit. And the reason why we use whole life is because of those guarantees. Another, I guess you could say, popular product out there you might have heard is called an indexed universal life. That gets a lot of marketing and it's pushed around a lot out there. It's not a bad product, but when we're talking about something like this and we're talking about taking money, pulling money out of the policy, you got to be really careful because especially with those index universal life policies is they illustrate really well, but it doesn't necessarily carry over to what's actually happening inside the policy. And there's, been stories of folks that took out an index universal life. They were promised that they can pull out all this money, and then the policy ends up running into a situation where there's not enough money in the account to sustain the long-term growth, the long-term sustainability of the actual life insurance, which causes it to lapse. So with a whole life, you have more guarantees where you're protected against that. So here's an example of a whole life policy that I wrote for a client. So she did it early on with her kids as soon as they were born. So the numbers for you might look a lot different. Let's say if your kid is already 8 years old, you're not going to have those years from year 1 to 8 for that growth because you've missed that growth. But nevertheless, you're going to get a lot of good growth starting with whatever age your child is right now. But this is just happens to be one of somebody who started it as soon as their kids were born. They were putting in $10,000 a year annually into the policy. You can choose to put in whatever you want and design these policies around, what you're comfortable with. So you can choose, let's say I'm comfortable with putting in $300 to $500 a month. So, we can run illustrations that show putting in for solving for $300 to $500 a month. And we can, kind of get in a hypothetical illustration of what that looks like. So in this column here, we have the net cash value. Okay. And, every year that's going to be growing as you're putting money into the policy. Of course, a portion of that money of the premium is going to actually go towards buying the life insurance. That's how this works. So you have your net death benefit and you have your net cash value. Now, as you take out loans out of the policy, so let's say age 16, you want to purchase a new car for your child. Instead of having to take out a car loan, you can use your whole life policy to purchase the car. Okay. Once you do that, you can create your own terms as far as paying back the loan. There's no set rules. So once you take a loan out of the policy, you're going to see a decrease in the death benefit. The money that's in the actual policy, the cash value, is still growing. Okay, since you're just taking a loan off it, but you're going to see, the net death benefit decrease. So if you're not paying back the loan, you're not going to have as much growth in the policy. So you can make your own rules. So let's say you decide that you want to, start paying back the policy, paying back the loan to continue to get the growth in the policy. You can do that. And let's say you want to skip a month or two. You can do that as well. It's not tied to any banking system or your credit report. And then as they get older, in their mid-20s, you can use this for, let's say, starting a business with your kids, or maybe it's, they're getting married and you want to help pay for the wedding. There's so much flexibility in using this product as far as what you use it for, how much you want to put into it. It's really customized and personally designed. Okay, so that's it for this video. I just wanted to kind of quickly go over, the benefits of starting a whole life policy with your kids. I'm not going to sit here and tell you that, you should do this before creating a college fund, but this would be a great addition. If you do have some type of college fund that you're funding, this would be another great option as well. You're putting more of the power into your pocket versus taking out loans. So if you have any questions about this, if you want to dive a little bit deeper, if you want to run some illustrations, go ahead, shoot me a comment or send me a message, and I'll be happy to get on a call and walk you through this. All right. Have a great day.